Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with George Milling-Stanley, who's the Chief Gold Strategist at State Street Global Advisors. George, great to have you on the show.
Back. Nice to see you, Sumit.
Likewise. So, George, everyone's been watching this huge rally in gold. It's already up 10% just since the start of the year, $2,900, a record high. What is driving this huge rally in gold?
Look, I think there are really three major factors here. The first is something that's been with us now for 15 straight years, and that is that central banks have been buying record quantities of gold for their official reserves. I think something like 15, 20 years ago, central banks, especially in the emerging markets, realized that they had way too much of their official reserves in dollar-denominated debt and very, very little in gold, less than 3% in gold if you go back 15 years ago. And I think that's probably a lot less than most of their citizenry actually holds in gold. Um, they've been buying gold now consistently for 15 years. Now those purchases basically doubled in 2022 when the U.S. effectively barred Russia from using the dollar and booted them out of the SWIFT system. And I think that basically accelerated the net purchasing by emerging market central banks so that it actually doubled to more than 1,000 metric tons in 2022. We saw a similar level in 2023 and again in 2024, more than 1,000 metric tons. So I think this is something that is going to continue to run. So that's the first reason. The second reason, we've seen a big increase in demand for gold, both in jewelry and as an investment, all across the emerging markets. That's the private sector as opposed to the public sector. And the third reason, we've also seen a big revival in Western world investment demand for gold, both Western Europe and North America. And I think that all of those three together are really what's behind this continuation of the surge that we saw last year.
So, when you say investment demand, George, are we seeing ETFs become buyers as well, or is that part of the market still kind of dormant?
No, I think that we've seen some decent inflows into gold-backed ETFs this year. It's still not as strong as I would like to see it, but nevertheless, I think it has strengthened considerably. We had a couple of years of outflows with people focusing more on small bars and coins, and also some large bar investment on the part of a number of organizations. I'm glad to see that it's now coming back into the ETF sphere as well.
So, George, obviously, we've talked about this huge rally in gold. I have a question. Investors, they might look at this rally and be interested in purchasing gold, but the price has already gone up so much. How does an investor decide whether it's a good time to get in, whether gold offers value? Because right now we're talking about $2,900 an ounce. If you go back 3, 4 years ago, it was between $1,500 and $2,000. So it's gone up 50% to 100% in that time frame. How does an investor decide whether they should buy now?
I think the main reason why investors buy gold is not so much because they're banking on an appreciation in the price. I think it has more to do with gold's protective attributes. Gold offers diversification in a properly balanced portfolio that can be matched by precious few other assets. Gold has no strong relationship with stocks or bonds or anything else you'd find in a typical portfolio. So that's one area of protection. Gold also has a long track record as offering protection against sustained high inflation over 5% a year for more than a 2-year period. Gold, again, historically has offered some protection against declines in the equity market. I'd point to Black Monday in 1987, the bursting of the dot-com bubble in 2000, 2001, the global financial crisis of 2008, COVID in 2020. In all of those cases, equities went down dramatically and gold went up dramatically. And again, historically, gold has offered some protection against a declining US dollar. It's those protections that I think are the main reason why investors buy gold. So the price is relatively less important to those kind of investors who are making a long-term strategic allocation. Now, in some years, for example, 2024 was an example, and it's shaping up that 2025 may be an example. Gold can offer you protection plus performance. And I think that's a very, very powerful mantra for investors all over the world.
That's great. So you talked about a couple of the things that investors might want protection from: volatility in the stock market, inflation, dollar depreciation, and things like that. Geopolitics has been another thing in the headlines recently. Does gold offer any protection from that?
Look, I think most people believe that it does, and that's the important piece. I've struggled in my 50-year career in gold, struggled to understand this. But I think that whenever we get a rising temperature of geopolitical turbulence, then I think that a lot of people historically have always turned to gold. And I think that's what we're seeing right now. We're seeing no improvement in the situation in Ukraine. And I think that we're not quite clear what our present government is what actions they're going to take. We've seen a worsening in the situation in Israel, with the conflict having spread way beyond Israel's borders now into open conflict between Israel and Iran. Um, and China still casting covetous eyes toward Taiwan. I think that all of those things were very powerful drivers of investment demand last year, and they haven't improved any in 2025. So I think that they are likely, as long as they remain in place, then they could well drive investment demand even further this year.
George, one really interesting thing, if you go back a few years ago, 2020, 2021, Bitcoin was taking off and gold was kind of flat. And this whole narrative was out there that Bitcoin was sapping demand from gold. No one really cared about gold anymore. It was all about Bitcoin. Now, fast forward to today, and we're seeing gold actually doing better than Bitcoin this year. And even when Bitcoin was hitting new highs above 100,000, that didn't really derail gold in any way. How do you view these two assets, gold versus Bitcoin? Because a lot of people consider them both to be safe havens. Are they just two fundamentally different assets? They don't necessarily compete with one another?
I think that they both do very, very different jobs within a portfolio. Um, Bitcoin, since inception in 2009, has generated some pretty interesting returns. No question about that. Especially if you exclude 2022, when the returns were disastrous. So I understand the quest for returns and people wanting to buy Bitcoin. But I don't believe that Bitcoin has the same kind of protective attributes that I just outlined for gold. And certainly since 2020, Bitcoin has been much more closely correlated with the S&P 500 than I would feel comfortable with in adding that into a portfolio. I like uncorrelated assets rather than strongly correlated assets. So I think they do different jobs. I think gold primarily is bought for protection, but in some years it has given very, very good returns, like last year and like the beginning of this year. Bitcoin is all about returns, and I think it's a very different kind of job that it's doing there.
Well, great. A lot of great insights there, George. Really appreciate your time. Thanks so much for joining us.
Thank you, Sumit. A real pleasure to talk to you.